So I think we've hit some of a pivot point. We've gone from obviously aggressive tightening toward the Fed kind of running into somewhat of a liquidity wall, and now they have to balance financial stability with their attempts at fighting inflation. You kind of have this multi-month window here where liquidity looks okay, but then the big challenge is that when they actually do get to the debt ceiling impasse, however that's resolved one way or another, when the Treasury actually then wants to refill its cash account and wants to, is able to issue debt again, that's a lot of new supply coming onto the market. I would say we're kind of still in this multi-month period, but there's like storm clouds on the horizon.
Renowned macro and market analyst Lyn Alden has warned investors to watch out for storm clouds on the horizon as the U.S. Federal Reserve struggles to control inflation through quantitative tightening, while simultaneously providing a bailout for the struggling banking sector. There is also the added factor of the debt ceiling, which Alden believes will definitely be raised to stop the ripple effects of the Treasury failing on its obligations. During a recent interview with the Wealthion YouTube channel, Alden discussed an updated macro outlook for the U.S. economy in 2023, especially her dire predictions of a liquidity crisis within the coming months. The renowned macro analyst and investment strategist explained that the Federal Reserve has consistently been sucking liquidity out of the economy over the past 12 months, as in 2018 and 2019, when they unwittingly blew out the repo rate. Just as they did in 2019 when the central bank started buying T-bills for financial stability, Alden is convinced they would have to step in again to do some much-needed damage control. But the problem might be much trickier to handle now than it was in 2019, Alden added. For one, there isn't an excess supply of T-bills currently. Instead, banks, especially smaller banks, are having serious liquidity issues. According to Alden, the Federal Reserve may have just a few more months of rate hikes and QT before they have to backtrack. Not just to keep the banking sector out of a wider crisis, but also to match drawdowns from the Treasury General Account, which the Treasury Department plans to continue cutting down. With the various mismatched elements, Alden believes the Federal Reserve has some quick thinking to do before the economy is hit with a severe liquidity crunch. We will now take you to Alden's interview as the macro analyst gives an insightful look into the current liquidity situation in the United States. Please watch the video to the end, hit the like button, and subscribe to the channel for more videos from Alden and other brilliant market analysts. Also, ensure you drop your comments and observations in the comments section below. Thanks, and enjoy the video.
So I think that's kind of the big story in financial markets is this kind of pivot in liquidity. I think the challenge is that we're still in this kind of stall speed area. So a lot of economic indicators have decelerated without going negative. And so they're either mildly positive, roughly neutral, maybe in some cases mildly negative, and other ones are still pretty strong. And we have this kind of window here between now and the debt ceiling, where liquidity looks pretty flat overall. So the Federal Reserve was draining liquidity. Now it's kind of a messy situation. They're still, on one hand, they're pulling liquidity out with quantitative tightening, but then they're putting even more back in with loans. You have the Treasury General Account is still structurally drawing down its cash reserve as part of its extraordinary measures when it runs into its debt ceiling. And a lot of that's already behind it, but there is still some to go. And so as they draw that out, that goes out to the economy, and that's actually pro-liquidity. I would say we're kind of still in this multi-month period, but there's like storm clouds on the horizon. And, there's almost two economies, right? So obviously very interest rate sensitive sectors, which is things that are really reliant on debt or issuing tons of equity, ironically. So if you look at the real estate sector, obviously that employs tremendous amounts of debt, and therefore that's very interest rate sensitive. That's obviously been a point of concern both residentially and commercially. And then the other one is tech. And people don't often think of it as a real estate, as an interest rate sensitive sector, but it is, because especially in this past decade, so many tech companies have in some cases sold their equity better than they sold their products. And what I mean by that is they keep their prices low. They operate at a loss, and they make up for it by constantly selling new equity, both to their employees and to investors. And that's what allows the company to keep going. And that works as long as interest rates are like zero and people are willing to just keep monetizing that equity. But when there's actually a cost of capital, that equity gets valued very differently. It's no longer economical to keep issuing tons and tons of it. And then the company has to raise the prices to try to close the loss that they're making, and then that slows down their growth. because some of their growth was only there because their products were underpriced. And then as their growth slows down, their equity valuations fall further. And you basically find out that a big percentage of that business was malinvestment, that there really was no there. It was just a underpriced thing that wasn't getting its market signals due to manipulation. And so those are kind of the two sectors that are obviously most concerning. Whereas you don't really see much stress in the travel industry and the restaurant industry, in certain other parts of the real economy. There's kind of a bifurcated economy.
In her March newsletter titled A Look at Bank Solvency, Alden notes that if the Federal Reserve continues on its recent path to bring down inflation, more small and medium-sized banks will be exposed to liquidity drains while larger banks benefit as investors seek stability and assurance. Here is an excerpt from the newsletter. If the Federal Reserve does continue to push forward by raising interest rates and performing quantitative tightening, the long tail of small and medium-sized banks are at risk of ongoing liquidity drains, starting with the most vulnerable and moving up from there. If the small banks sharply raise interest rates to keep deposits, then they risk getting into solvency problems. The beneficiaries of this flight to safety would most likely be several of the largest banks and money market funds. If unchecked, this could be the fuel that facilitates more consolidation of small banks into large banks. The JP Morgans and Wells Fargos win it all as investors and depositors run for safety. Let's get back to Alden's interview as she further discusses the burdensome task ahead for the Federal Reserve and Treasury Department.
I think it's really concerning for quarter 3 or quarter 4. I think right now we're in a little bit of an eye of the storm where, like I said, liquidity indicators look okay looking out a couple months, because you kind of have liquidity being taken out and other liquidity being put in. And the question is, when you get towards the later part of this year, when a lot of these things all coincide to kind of be bad for liquidity and bad for growth, I think that's where storm clouds hit. And how concerned to be partially comes down to how you think people are going to navigate it, right? Because this is an actively managed system, and a lot of it will come down to human decisions. And there's ways to cause a massive liquidity shock, and there's also ways to just kind of like flood it with liquidity, and kind of weaken on the inflation fighting front. And so I think it'll be pretty pivotal decisions by the Fed. I think an instructive period to be familiar with is the repo rate spike of 2019. That was the last time that quantitative tightening ended. The Fed was drawing down their balance sheet in 2018, 2019, and they did so until September 2019 when they caused their repo rate between banks to blow out. And the Fed had to come in and participate in the repo market. But there are a number of us at the time that were pointing out that they were basically, the system was being flooded with T-bills, and the Fed was going to have to start buying some T-bills. And about 3 weeks later, that's what they had to do. And I think we're kind of in a similar environment now, where right now they're still trying to be tight with their actual balance sheet, but then they're offsetting it by loans. And I think they're going to find a time later this year where they're unable to keep doing quantitative tightening. It doesn't mean that they necessarily turn to QE right away, but I do think that at least on one of those liquidity fronts, that quantitative tightening portion, I think that's likely to stop, because there's not much else liquidity that can come from the system. And I think that's the thing that I think they overall kind of basically overestimated how much liquidity is in the system. And another factor that's challenging is that the Treasury generally has options. I mean, they could, for example, when they want to refill their Treasury general account, they could issue almost entirely T-bills. They could issue a flood of T-bills, and that would pull liquidity out of the reverse repo market most likely. And so that would actually be the least harmful way for liquidity in order to carry on. But of course, it would shorten the average duration of U.S. Treasury debt. It'd be the least interest rate effective way to do it. So again, it kind of comes down to like choices by Yellen and others of how they want to handle that.
In her newsletter, Alden highlights some action plans that might help the Federal Reserve get a better handle on the situation. According to the macro analyst, the Fed can consider a basket of anti-dollar positions such as gold, oil, commodities, emerging markets, and Bitcoin to avoid hurting small banks while keeping a lid on inflation. She adds that bank depositors should ensure they are under the $250,000 FDIC insurance limit and opt for T-bills and money market accounts for higher amounts. For businesses, Alden advocates using multiple banks, moving unneeded funds into money markets and other protective measures. What are your thoughts on Lyn Alden's assessment of the current liquidity situation in the United States? Please drop your comments and observations in the comments section. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.